Welcome back to the deep dive. Today we are pulling up a custom screen and we're zeroing in on the communication equipment sector. But with a specific filter, we're looking at one thing, just massive trading volume.
Right. Because that extreme volume
Yeah.
really tells you where the market's energy is, where its focus is right now.
Exactly.
And we're not just talking about legacy infrastructure here. We're really analyzing the nerve center of modern tech.
The huge demands of AI, 5G buildouts.
Exactly.
What?
And even really specialized stuff like autonomous drone systems. The three stocks that popped up on our screen, they represent, well, three totally different ways to play this sector.
Okay, so our mission today is to take these three high-volume names and really decode them. We'll look at the basic metrics, the technicals, the news, the financials.
You'll run a few scenarios too.
We will. Now, before we get into any of the numbers, just the necessary point here for you. All the prices, the technical analysis, and, the profit and loss scenarios we're about to discuss are purely based on historical data.
For educational and analytical understanding.
Right. This should not be taken as investment advice.
And that high volume filter is key. These stocks are generating massive market interest, which, usually correlates with some pretty aggressive price action or major news.
So who's on the list?
All right, we've got Ondas Holdings, ticker ONDS, then the networking powerhouse, Cisco Systems, CSCO. And finally, the reinvented telecom giant, Nokia, NOK.
Okay, so let's unpack this high flyer first. Ondas Holdings, ONDS.
This one is a different creature entirely.
It really is. It's a smaller U.S.-based company, but it's focused on these highly specialized sort of mission-critical areas.
We're talking industrial wireless radio systems, and this is the big one, Ondas Autonomous Systems, or OAS.
Which is all about commercial drone solutions and defense applications.
And the initial data just screams volatility. I mean, this stock is trading with huge volume.
Almost 220 million shares recently.
Which is just massive relative to its market cap of about, $2.4 billion?
Yeah.
And that volume, it caused the stock price to surge over 19% in a single day.
And here's the aha moment. That explosive jump came right after their Q3 2025 earnings report. They reported a loss, but the market just didn't seem to care.
No, because revenue was strong. It beat expectations, and the growth outlook is what everyone was looking at.
All driven by that OAS division and some strategic acquisitions focused squarely on military and defense.
This is a pure growth bet. The financials are just proof of that. You see this eye-watering sales quarter-over-quarter growth over 550%.
Year over year is still around 75%.
But here's the rub. They are deeply, deeply unprofitable.
How bad is it?
The profit margin is a brutal negative 307%. The gross margin is it's actually slightly negative. You are betting entirely on future contracts paying off.
And the valuation just confirms that extreme future expectation. The price-to-sales ratio is astounding. It's 149.52.
Yeah, to put that in perspective for you, the market is valuing this company at nearly 150 times its current revenue.
Which only makes sense if you really believe in that estimated 5-year growth rate of over 75% for earnings.
And the technicals, they just echo that risk. The beta is 2.39.
So it moves more than twice as much as the overall market.
Exactly. And its performance has been just staggering. Over the last year, it's up an unbelievable 718%.
Okay, let's run the paper money math on that, just to see the sheer potential of this kind of volatility.
Right.
Imagine you're a high-risk investor. You put $5,000 into ONDS at its 52-week low, which was about a year ago, at 57 cents.
37 cents. Okay, so that entry point would have netted you, let's see, approximately 8,771 shares.
Wow.
So using the recent closing price of $6.56, that's a gain of $5.99 per share.
So that initial $5,000 investment
is now worth an estimated $52,580 in profit. It just dramatically highlights the explosive potential, but also, the massive risk that comes with these speculative microcaps.
All right, let's move to the complete opposite end of the spectrum. Let's analyze Cisco Systems, CSCO.
The definition of stability in this sector.
Totally. A massive $305 billion market cap, a core component of all the major U.S. indices. They are the market leader in networking.
And Cisco is the one that really proves this sector isn't just about high-risk gambles. It's also about mature companies successfully integrating new tech.
Precisely. CSCO's recent earnings in November caused a pretty significant 4.62% jump in price.
And that was driven entirely by high demand for AI networking gear
Yeah.
and a really optimistic outlook for 2026.
And the market reacted immediately. Analysts like UBS and Erste Group upgraded the stock right away.
But here's where it gets interesting. There's this conflict, right, between the positive market news and the internal activity.
You're talking about the insider sales.
Exactly. Our data shows continuous high-value insider sales by executives all through 2025. You've got the CEO, Charles Robbins, selling millions in August, similar sales throughout the year.
So the question you have to ask is, why are the execs continuously selling into such a strong AI-driven rally?
It is a massive red flag for a lot of investors.
Yeah, are we giving too much weight to the AI story if the people actually running the company are cashing out?
It's a fair challenge. It's a necessary lens. But, for a blue chip like Cisco, a lot of those sales are often scheduled way in advance, part of tax planning or diversification.
So it's less likely to be a crisis signal.
Less likely than it would be for a smaller company, yes.
Yeah.
And the market seems to be weighing this against just rock-solid fundamentals.
And the fundamentals are solid. Stable profit margin over 18%, gross margin almost 64%, healthy return on equity.
And the valuation looks very reasonable. The trailing PE is 29, but the forward PE, that drops to 17.35.
Signaling strong expected earnings growth.
Right. And unlike OMDs, they pay a consistent dividend, over 2%.
The technicals also confirm that momentum and stability. The RSI is high, 71.33, so it's moving into overbought territory.
But the beta is low, 0.87. It's less volatile than the market.
And the performance is robust, about 32% year over year and nearly 17% in just the last quarter.
So let's run the paper money math for this steady growth story.
Okay.
If you had invested $5,000 3 months ago, right before that strong quarter, your entry price would have been around $66.20 per share.
Okay, so that $5,000 would get you approximately 75 shares.
Right. And using the current close price of $77.38, your paper profit would be those 75 shares times the gain of $11.18 per share.
Which comes out to
a profit of $838.50. It's a steady, respectable gain over a short period. It's the profile of stability, not explosion.
All right, finally, let's turn to our third one, Nokia Corp, NOK.
The turnaround story.
It is a large multinational based in Finland, now focused on mobile networks, network infrastructure, and cloud services.
Yeah, Nokia has struggled for a while to sort of redefine itself after this, the phone wars. But the recent news suggests they are finally leveraging their network expertise into these new AI infrastructure demands.
And what's fascinating here is the massive catalyst from late October.
The NVIDIA investment.
NVIDIA's $1 billion investment and strategic AI partnership. It just jolted life back into this old telecom giant.
And it raises a really important question. How does an investment from a major AI chip maker fundamentally reposition an established networking company like Nokia?
Right.
That $1 billion isn't just a friendly gesture, it's an active stake.
Yeah.
It's meant to accelerate Nokia's capabilities in areas that are critical for NVIDIA's own growth.
Okay, but let's be critical for a second. Is $1 billion really enough to turn around a $37 billion company? Is this whole turnaround story being overhyped?
That's a crucial point. $1 billion isn't a colossal amount in this sector. But the market reaction, I think, is less about the cash itself and more about the validation.
The partnership.
This strategic partnership. NVIDIA doesn't partner lightly. So this deal, plus their Q3 earnings, which beat estimates, it really sets Nokia up for a future recovery, even with some recent negative EPS contractions.
And the valuation seems to support that recovery story. The trailing PE is high, 38.74.
But that forward PE drops massively to 17.34. The market is pricing in significant earnings recovery, basically matching Cisco's forward expectation.
They also have a strong cash position, low debt, and they pay a decent dividend.
Almost 2.5%.
And the technicals show the dramatic impact of this news. Performance is up over 61% in the quarter and 20% in the last month alone.
But the stock is sitting very close to the general analyst target price, which still suggests a hold consensus. So there's some caution there about immediate upside.
Okay, let's do the final paper money math here. Assume you invested $5,000 right before that NVIDIA news hit in late October.
So we'd use an estimated pre-announcement price, say around $5.55, to account for that surge.
Right.
That $5,000 investment would get you approximately 900 shares.
And at the current close of $6.78.
That gives you a profit of $1.23 per share. So the total profit comes out to an estimated $1,107.
A quick rapid gain. It just shows the impact a major strategic announcement can have. So an incredible exploration of three very different stories in one sector. We had the high risk, high reward of Ondas Holdings,
The stable, AI-driven dominance of Cisco.
and the revitalized value proposition of Nokia, all thanks to that partnership.
The synthesis is just. It's so clear. The diversity is stunning. But the one underlying thread for all three of them, regardless of size or risk, is the escalating demand from AI infrastructure and new global network requirements.
So what does it all mean?
Well, the data shows that volume isn't just about company size. It reflects exactly where volatility and major news catalysts are grabbing the market's attention.
And offering very distinct profiles: explosive speculation, steady stability, or major recovery.
So as you think about this data, here is a final provocative thought for you to take away.
Go on.
Consider how much of that extreme 700+% year-over-year performance from Ondas is actually sustainable, based on its current negative margins.
Versus how much is just tied to volatile short-term sentiment around defense and drone contracts.
Exactly. Is that extreme valuation justified purely by the potential of defense procurement cycles? Or does it require immediate large-scale profitability to hold up? That's a deep dive for you to consider next time.